Welcome to The Big Break Show, a podcast where we discuss short-term rentals, entrepreneurship, life, mindset, and everything in between. Here are your hosts, Rafa Loza and Jesse Vasquez.
On this episode of The Big Break Show, my co-host Jesse interviews
Adam and Dan of Host Financial, and this is actually episode
45.
45. You're absolutely right.
Yeah, you guys, right. I wasn't sure.
You guys, today's episode, we have two pioneers that are trailblazing this. I sound like I'm like creating an actual soundtrack for them, but I'm really excited because they are one of the first companies I've ever seen that was able to bring capital to the investment side of the short-term rental space, where they're actually brokering deals based off of short-term rental numbers. And Rafa, we talk about how this adoption of financial institutions has been like non-existent, and they're one of the first people that started doing it. We're starting to see it kind of trickle in, slowly, but they're just really making things happen. These are two relatively pretty young guys in the space, so they see and they're looking forward. They're progressive. They're thinking forward future. As far as anybody looking to get a loan, definitely want to reach out to Host Financial. What do you think, Rafa?
Yeah, no, this was great. I actually learned about them when I first started my short-term rental journey back in 2017. But because I do a lot of arbitrage, I couldn't really work with them. Right now that I'm at the point where I could work with them, I'm definitely going to reach out to them because they really are the leading company, the front runners, and they're the ones who kind of stabilized or established the rules for short-term rental lending. They were one of the first ones, or at least one of the first ones that I knew about. So I was so excited to have them on the show, which I'm glad you brought them on, because not only do they talk about lending, but more than anything, they're so knowledgeable in the space. They give so many good tips and tricks on what you can do to, number one, be a good operator. Number two, get yourself set up for good financing. Number three, know how to actually run and analyze deals. And they give away their calculator on their website. So I'm really excited for the listeners to get some good info. This is one of these episodes where somebody better walk away with something that they can apply to their business or learn to get started in short-term rentals. If you guys don't take this and apply it today, y'all on the wrong podcast. I
agree. Yeah, not only that, but Rafa, they talk about, the properties to look for, not necessarily just those places that we, the big areas, Gatlinburg, Joshua Tree, focusing on other places that are unique, even if you're buying in a place that's saturated, but being that different comp, being that other unique property, that's what's going to set you apart, especially as we move forward in this space. So super good episode. I'm grateful to have these guys on.
Yeah, they give a lot of insight on how to stand out and how to be that good operator. So hopefully you guys enjoy it, man. Give us a thumbs up, like the show, give us a 5-star rating on iTunes and Spotify. We do this for you guys. So enjoy it, take advantage of it, take our knowledge, apply it, go out and build your business, and leave a comment letting us know how many units you got and when you started. And without further ado.
What's up, everybody? We have Daniel and Adam of Host Financial. I'm super excited because I've actually heard about you guys many years ago, and I've always wanted to have you guys on the podcast. And now we actually have both of you guys here today. And we know that short-term rentals are becoming an asset class in itself. And I think it's really cool that you guys actually started funding short-term rentals in the real estate market years ago based off of actual numbers projected like through AirDNA or Mashfires or whatever these things are. So yeah, let's dive into that, you guys, because the investment portion, the funding portion of short-term rentals can sometimes be confusing and not understand, like people don't get it. So that's why I want you guys to be here to kind of educate folks on this stuff and also talk about some of the products that you guys have that you can offer to our people. So tell us, Adam, Daniel, whichever one of you guys wants to go first, like what is Host Financial? Tell us how it got started and what the mindset was behind it.
Yeah. So first of all, Jesse, thanks for having us on and reaching out. So a little bit about Host Financial and how we started. I've been a lifetime entrepreneur. I sold a company in 2018 and always dabbled in short-term rentals. And then when I sold the company, I wanted to dive in deeper. And one thing that I discovered was, I went to conferences for short-term rentals and I was looking for financing, and I noticed that nobody was focusing on servicing financing for the short-term rental investor. So that was my barrier. I didn't come out a finance guy. I wasn't in real estate before, just a lifetime entrepreneur. And I was seeking the solution to my problem and finding out there wasn't really anything there. So as a result, I had met Adam through a mutual friend. I knew he was in real estate and development and finance. And I reached out to Adam and said, hey, here's this problem that I have. I need financing to acquire these properties to use as a short-term rental. I'm from the conventional side, which is usually, the toughest thing to get financed from for short-term rental is I don't have a W-2 income because I was an entrepreneur. I'm liquid. I have all these hurdles for conventional financing. What other solutions are there for the lending markets to understand and finance these short-term rentals? And we got talking and figured it out for myself. And as a result, just that thinking, if you're solving a problem for yourself, there's likely other people that need the same thing. So that's sort of how the idea came about, was solving our own issues, our own problems regarding short-term rental financing, and then creating a company around that. Because everyone I spoke to at these conferences also had the same issue. So yeah, that's how the gist of how it started. From there, sold the company in 2008. My previous company was getting into short-term rentals, and beginning of 2019, found some solutions for it and launched Tush Financial beginning of 2019.
Yeah. And like Dan said, my prior background was in real estate development. So, I was in commercial real estate development in San Diego for about 10 years. So when Dan and I started talking about, his problem on the short-term rental side, we're starting to look at some of these STR deals, and I'm looking at it from like a developer's mindset, right? So, seeing what the cash on cash return is, or looking at some, 5 or 10-year IRR metric, and the numbers, just from a traditional development perspective, were fantastic. So then you couple that with the fact that they're very difficult to finance because they are such a relatively new asset class that's emerging and maturing and going through that whole process. It just seemed like there was an opportunity for us to really create a company that was focused, solely on solving this solution for the short-term rental investor. It's not as simple as just, we created some loan programs or, found some capital sources that can work for these short-term rentals. What we've really tried to focus on is being like the experts on the financing side for these deals, and really focusing on creating and solving the problems that the investors have, because every deal is a little bit different. It's not a one size fits all type of program. And that's what we really strive to do is find those custom tailored solutions.
So I want to kind of jump right into it. The products that you guys offer, if you guys don't mind me asking, how does it differ from like someone going to like a regular lender and trying to apply for a loan?
Yeah, so if you're ever gone through the personal process to buy your own home loan, anyone who's gone through that knows that there's a lot of documentation that's required. You have to provide your W-2s and your tax returns, and you've got to provide your bank statements and all these different items. And what those lenders do when they have all that information is they are analyzing your income and computing your debt to income ratio, right? How much money you make versus how much your car payments and your student loans and what your total debt load is. And then based on guidelines from the government, I think it's 43% debt to income ratio or something. We don't do those loans, so not as up on those type of metrics, but they'll look at that and determine, okay, you make X, your debts are Y, you can afford, this much additional debt. And that is what traditionally a lot of short-term rental investors use to qualify to buy these homes. They would just go the conventional route. So what that really lacks in, and the big deficit of that and the opportunity that we saw, is they don't look at the income potential, the cash flow of the property, and use that as a way of underwriting the loan to determine like, okay, this property is $500,000. We're going to put an 80% LTV loan on it. But as a short-term rental, it's going to gross $150K. Well, that cash flow is going to go to service that debt. And it's a very common practice in any type of real estate and development, or any type of cash flowing piece of real estate, like whether it's an apartment building or a strip mall or retail center. You're looking at the income of the property as part of the underwriting factor, right? You're not just, you buy a $5 million strip mall, that individual that buys it doesn't have to be able to afford it, the debt on that strip mall, with just how much money they make, right? You're going to take the income from your tenants and the leases and everything else. So it's kind of applying that same concept to short-term rentals. So that's the big difference. When the type of loans that we're doing, we're not looking at the individual borrowers' tax returns, not looking at their debt to income ratio. We don't care about W-2s. Like to Dan's point, like a lot of self-employed or entrepreneurs or even real estate investment professionals, they intentionally try to show lower amounts of income on their taxes because they're doing depreciation and everything else. So we don't look at any of that. We just basically primarily focus on this property can earn what X as a short-term rental. And we use that to underwrite. That's the biggest difference.
I love that. So I want to ask you guys a quick question around this. What are some of the challenges that you guys see with someone that's fresh coming out and saying, hey, I want to run the short-term rental. Here it is. You guys run your numbers. Like what's the challenges that you see in qualifying people above anything else?
Challenges that I would see is making sure that their credit's good. But that's for any lending is, their credit scores, making sure they're keeping on top of that, monitoring it, understanding different types of credit scores. There's, FICO 8, there's some for auto scores, and others use like FICO 5, FICO 2 for mortgage lending. So a lot of people will use, they'll monitor their credit, think it's good, using Experian, but that's just following one type of credit score. So maybe using services like myfico.com, running the full report to really get a true picture of where you stand. And then, if you're not there, not at maybe a 680, which is typically what the minimum that you want for good terms, working with a credit specialist to get prepared for the financing portion of this and improving your credit score. That's one barrier or one hurdle.
Yeah. Another thing I would say, I guess, as a barrier or maybe advice to somebody who's looking at short-term rentals to kind of get started is really, making sure not only that your credit score is good, because that directly affects the rates that you're going to get, but just making sure that you're financially prepared. A lot of people focus just solely on, can I get enough money saved up for the down payment, without factoring in, on any real estate transaction, you've got additional costs above that between closing costs and insurance and all these other things. But then on top of that, you really want to make sure you've got a reserve built up too, because, short-term rentals are cyclical. They are seasonal. So if you put every last dollar you have into closing the real estate and you have one off month, it can put you in a really bad financial position. So, if it's something that people are interested in getting into, really kind of building up that nest egg for the purchase of the property, to close on it, and then as well to make sure you've got an operating reserve in case any cyclical down months happen. And I think that's probably a common pitfall for the first time investor, is just not really putting themselves in that financial position to weather any type of potential downturns.
Yeah, I'll add to this with the. Don't rely too much on external data sources. I know we can use AirDNA projections to underwrite the income, but it's still an imperfect tool. Really, any data analysis tool is still imperfect. So really try to understand your market, talk to other operators in the area, and work out your real, some real numbers. And also, once again, if you don't have reserves, make sure you have reserves, and also understand it's prudent as an investor to understand what your plan B is going to be. Say, there's a recession and travel takes a hit. What kind of market are you in? Are you in a market that you can plug in a long-term renter and cover the debt? Can you, change to a midterm rental, get traveling nurses or corporate housing, cover the debt? What sort of plan A, plan B, plan C, worst case scenario do you have for the property? So you're not, coming out pocket every month on the investment.
Yeah, I mean, it's prudent for any type of investment, whether it's short-term rentals or long-term rentals or retail centers, whatever it is. You want to look at not only just your upside, but you want to have that downside scenario. What do I do when my assumptions don't prove out, or the economy moves against me, or other unforeseen items happen? You want to have multiple different strategies so you can kind of deal with market forces as they come.
Yeah, I think you guys are absolutely correct. And, an intelligent investor is always going to have an exit strategy from day one. And the thing about short-term rentals is they're sexy, right? Everybody's getting into them. They've been doing it for a while. You guys probably watched your business boom since 2019 up until, it's probably slowed down a little bit because of the way the market's going. If not, maybe picked up. But a lot of people look at this. There's so much social media around Airbnbs and how much money they make. If you go on YouTube and just type in Airbnb YouTube, you'll see a bunch of guys walking around with $1 million. Like, I made $1 million with Airbnb or blah, blah, blah. Like, dude, that's not how it works at all. It's a lot of work. And those numbers that you guys just brought up, like AirDNA and all these other companies, Daniel, like they're not like 100%. Those are like bucket drops. They're putting all these properties together, and you're basically dropping a bucket in there and how much you can potentially earn. So you cannot base your income around those specific numbers. So let's talk about that for a second. Like, what does the underwriting look like?
Yeah, you brought up one good point too that just wanted to tack on to that is that, you can go on YouTube and you can go on all these social media and you can see all these gurus and people out there talking about how they're making all this money. And that's enticing a lot of people to jump into the market. And a pitfall, just a point of caution, is just to understand what 2020 and 2021 were in relation to like the broader market, right? Like COVID was one of the biggest black swan events that anybody could have predicted. We all thought it was going to just decimate the travel industry and the short-term rental industry. And really the opposite happened, right? All these locations that were outside of major metropolitan areas, these short-term rental markets that were a couple hour drive from, Atlanta or New York or wherever, just exploded because people wanted to get out of the city. They took their whole family. Everybody's working from home. So the numbers in 2020 and then even carried in through 2021 as we were still tailing off on the pandemic, the work from home was still fully in effect. None of the big employers were really reversing that. So 2021 numbers were just astronomical as well too. So you got to remember that, those were, two anomaly years. And if you get into a deal, just looking back on what 2020 looked like, or if you're buying a short-term rental from, an operator and they're advertising, hey, it did, $200,000 in 2021 and, even more in 2020 or whatever it is, it's like, well, look back on what 2019 was because, those are anomaly years and it's not guaranteed that type of performance is going to continue, on a go forward basis.
Yeah. And it's happening right now. I have, I know a lot of people in say a destination area just like that in Joshua Tree, anybody and everybody, a lot of newbie operators went out there and just with gangbusters with the interest rates, requiring properties. And really there was no way that you could fail because of the demand that, the demand that was attracting, drive away destination travelers, due to the COVID incident. And now what you're seeing is, restrictions have opened up, travel has swung in the opposite way. Everyone wants to get out, everyone wants to travel internationally. And those markets are taking a hit, although it's also, I would say, not indicative of the future performance of a market like that because the pendulum is swinging. But a lot of these investors are hurting and they're coming out of pocket every month and might need to sell. And you just don't want to put yourself in that position. So really, as Adam said, be prudent with your data, look at 2019 and really understand your market and not rely again, I'll say too much on these data tools. Really do your research and network with other operators.
So I'd actually have a question based around that though, because what we noticed was when travel hit really hard after COVID, the outdoor market areas boomed super hot, right? Like you guys were just saying. And you can't really use the data from 2020 and 2021 to do future projections at this moment because, again, an anomaly. Like the numbers were just extremely blown up because people couldn't go anywhere but those areas. So how is that affecting you guys' like underwriting model in terms of getting a loan going forward in any of these specific markets? Do you guys go back and track like prior COVID data, or do you guys do like, because you're Daniel, you're saying a lot of stuff about like how maybe talk to other operators in that market. Do you guys do that when you're underwriting a deal for someone to get a loan for, or how does that look for you guys?
Yeah, not on the underwriting side. This advice is just more kind of just prudent advice for any investor. So, what is allowable from like a loan origination underwriting standpoint can oftentimes be different from, what you should do as an investor. But yeah, it is becoming more highly scrutinized, and the way, a lot of underwriters are hedging against that, right? So you'll take a look at what the AirDNA figures may be, which I can't remember what their whole data set is. I don't know how, if they go back just 12 months, 24. But what more underwriters are doing are discounting even what the AirDNA figures are and taking, assume 20 or 25% off the top of that. And then using that resulting discounted income to underwrite. So that's mainly how, on the loan side, the underwriting is compensating for potentially having an up year. The other way too is, when we're analyzing these deals and short-term rentals tend to be we calculate what's referred to as a debt service coverage ratio for these loans. It just means we're dividing whatever that effective income is by the cost of the financing. So the principal, the interest, taxes, insurance, HOA fees. And that gives you a ratio called a DSCR, debt service coverage ratio. And when we're analyzing these short-term rentals, usually we're looking at 1.5x, 1.75x, 2x, meaning the income is double what the cost of the loan is. So even if you have a compressed year, right, you're still far above just what your break-even point is. So, if you've got a short-term rental and you calculate that debt service coverage ratio and it's like right at a 1.0, which would be what essentially a break-even is, that's where underwriting scrutiny gets a lot more heavy because you're just barely making the payments, right? It's just the property's just barely covering the loan. It's probably, a riskier loan unless you've got other compensating factors like, 12 months of reserves, right, in a bank account or something like that. So that's when, that's how underwriters are scrutinizing them, is like when those factors, when you're looking at all the data on a loan, start to point on whether it's getting too risky or less risky.
So is there a percentage of revenue that you guys look for, like conservatively in terms of numbers, saying for that debt service to be covered? Like you were saying, like 1% or the one time rule would be break even. Do you guys look like for example, if it's supposed to be like your expense ratio is going to be $3,000 for everything all in, do you guys look for a number above that in order to absolutely be able to cover the loan type of situation? Does my question make sense?
Yeah. So let me see if I'm getting this correct. So in terms of calculating the DSCR, and the formula is the net operating income divided by the total expense load. So to give simple numbers, say the principal and interest, your mortgage payment plus your monthly, yearly taxes, HOA fees, insurance, say that's $1,000 a month for this property. And then let's say, the income of the property, say even if we're discounting it at 75% or 25%, that 75% is the net operating income. Say that's $1,500. That's a ratio of 1.5. So that number is, above what we need to qualify. Typically in any of these types of programs, it's 1.25 or above. So, the income, the net operating income is just the revenue that's projected, either discounted, or if we have actuals, then, we can use that.
Yeah, I mean, the program itself can go all the way down to a 1.0 qualification. Like that's allowable in the guidelines. But, again, when you start getting really close to just what the minimum allowable is, that's when more scrutiny starts coming out. But typically, like Dan said, we like to see 1.25 and above. That's going to give you the best pricing. Even 1.5 and above will give you better. But that's what I kind of mean, getting back to what we were talking about before, is it's the quality deals that are the ones that are going through right now. The ones that have like a 2x DSCR, strong cash flow, good market. Those are the ones where experienced investors and experienced operators are still buying properties, even with the elevated interest rates we have now, because the performance is still so good. Back in 2021, again, we could go down to a 1.0, and we saw a lot of deals at that 1.1, 1.05, really low levels back in 2021 we're going through. And it's that part of the volume in the market that is not transacting anymore, because people know, like in this potential recessionary environment, increased interest rates, if they're going to go into a short-term rental, they want to make sure they've got a really good buffer, really strong cash flow. So though it's like the cream of the crop are the deals that are going through now. And it's some of these, wishy-washy, not as strong deals are the ones that investors are turning away because it just doesn't make economic sense anymore. So that's what I would say, is really focus on, deals that are strong. You want to give yourself that buffer in addition to your reserves and your due diligence and everything else. You want to make sure you've got, some wiggle room.
Yeah, I totally agree with you guys. I mean, if I was in your situation to underwrite, I wouldn't even be looking at anything unless it was like 2x. And that's how I am. That's how I look at stuff now. And I'm pretty sure Rafa does the same deals too. Is that 2x, 3x is like that sweet spot, right? If you can get 3x, then you're freaking doing fantastic. But even that 2x spot, you got to always have that. And you brought this up, Adam, earlier, like anybody new getting in here, you have to have reserves because you got to furnish that place. There's going to be the lending costs that come along with it. And I think a lot of times newbie investors, they get into it and like, oh, cool, you're right. I saved 100 grand for this place. I can get it. I got my 20% down. We got our loan, but shit, now I got to put 30,000 into the furniture. We got to do paint. We got to do, we got to make it STR ready. And you're all in it.
Professional photography. Yeah.
Yeah. And you have to sometimes, especially if this is your new property or first property, you have to figure out, how to get it booked. You might have some build-up time to figure out what the formula is, what your tech stack is to help operate it, to really make it an efficient, investment.
Yeah, that's actually what I was going to add to it. Your actual operating expenses too, on top of everything that the loan requires, the interest, taxes, all that fun stuff. You still got to talk about the actual operating cost, the tech stack, the PMS software, right? Your resupplying consumables, all that stuff has to be accounted into there. Do you guys account that into those numbers as well, or is that just like something completely off the side?
Yeah, no, we don't account for those specific things on an individual deal basis because, everybody runs their business differently, right? So it'd be impossible to apply something like that, uniformly. But it's all kind of captured, like I said, when we look at whatever that income figure is, the gross income that we're starting with, we reduce that by some factor, 20, 25%, depending on the specifics. And then we use the resulting number, the net income number, to run the calculations. That's kind of how it's taken care of in a broad sense. But yeah, those are great points that we didn't even mention before. In addition to the closing costs, is furniture, professional photography, tech stack. There's a lot that goes into it. And don't want it to seem like it's too doom and gloom. Just these are things to look out for. But the upside on these short-term rentals is still so high. If you're picking the right properties and you're doing your due diligence, the returns are just, so far and above what you could get just on operating a traditional rental. The work is more for sure. And the risk, I wouldn't say is more, it's just different kind of risk. And you just have to be prepared for that. There's risk. Look, COVID's a great example. Long-term rentals, supposed to be really safe, right? You got a tenant, leases, they make their payments, you're good. Well, COVID happens, eviction moratoriums, can't kick anybody out, everybody stops paying their rent. That was one of the funny things that we saw, funny as an odd in 2020 is everyone assumed it was STRs that were going to get hit. And the investors that we worked with, it was the opposite. They're like, my long-term rentals are the ones giving me the most problems right now.
Yeah, you're absolutely right. I saw that happen too. And a lot of people didn't pivot. One of the things too, Daniel and Adam, is, and I wanted to bring this up to you guys earlier. So Airbnb, they're IPO now, right? We can all see how much money they make, all that stuff. So 68% of their revenue, 68% of rural markets grew in 2020 to 2022. Like places that you guys probably never even seen before, that all of a sudden, boom, we're hot. Like I live near the Bay Area. So Bay Area folks were driving to Yosemite. We're driving to Don Pedro. We're driving to all these little areas that normally people didn't really go to. And then there was a lot of opportunity there. So like, are you seeing those little areas now, like starting to kind of simmer down? Where they were booming at one point, and now they're just kind of not what they were at 2 years ago. So what would you caution investors to come in and look at now?
I wouldn't say that they're simmering down, from like a return perspective. It's more those markets like get saturated, right? Like there's the Gatlinburg, Smoky Mountains, Pigeon Forge area, right? That's where a ton of business went in there, and literally every cabin out there, same style, same log cabin, same everything. That market got saturated, and people started looking at other ones. So I think that's more what's happened is, these towns that saw these big booms, especially if they're smaller rural towns. There's only so many like homes out there. It's not like a bunch more being built. So yeah, the markets will get saturated. So it just goes back to the due diligence, right? It's just understanding, when you're looking at any given market, are there tons of other properties that are exactly like the one that you're going to buy? Is there something which is becoming equally and more important? Is there something about this property that you're looking at that is unique, that you can market it being unique? Like, how does it stand out from the crowd? Is it, is it a better view? Is it got good stream running through it? Is it, got some other experience tied to it that is going to make it, stand out, that people are gonna be like, in the sea of 50 houses in this area, I want to book that one, and here's why. So that's a really important thing I think investors should be looking at, is how you differentiate yourself.
To elaborate on what Adam's saying about differentiating yourself, the reason, and I think we all understand this, especially you guys, is the the reason people that use Airbnbs are for a few reasons. Is one, it's the the size of the party that's traveling. You're not going to stay in a split everyone in 10 people, friends, family into 5 different hotel rooms. You would rather stay in a house. In addition to the travel, what travelers want these days is an experience, something that's unique, and you can do that with a property. Rather than going to a Marriott where it's very cookie cutter, they want the experience. And furthermore, what we're seeing is operators really tailoring their brand, I will say, and I definitely want to highlight that people are building brands of Airbnbs to tailor it towards a specific demographic, whether it's families. Someone in a property in Orlando by Disneyland, they've made a child's room, look like Super Mario, for example, or tailoring it towards extreme sports enthusiasts. I know someone had bought 5 houses in an area and built a BMX park in between it. So really just tailor it towards a demographic that they're not going to get that experience anywhere else. So they're going to book with you.
Yeah. I mean, it's kind of moving away from just being accommodation and an alternative to hotels to where, yeah, it's got to have something than just being a substitute to a hotel, because, as we've seen, there's lots of articles out there about pushback on cleaning fees and all these different things. It's like, if you just need to go stay for a couple days somewhere and it's just purely accommodation based, sometimes a hotel's a better option. A lot of times a hotel's a better option. But if you want to have that experience, you want to bring all your people together, you want to be in the same house, you want to be in a location that you don't normally go to, you want to get that experience, then that's where STRs and short-term rentals are really kind of differentiating themselves.
So I love what you guys are saying, because we talk about this all the time, me and Jesse, how you can stand out, right? Like in my corner, there's I think like 350 units now. And I'm usually always the one that's getting booked out because my place, number one, is super high-end design, super high-end looking. And it stands out. There's nothing special because I do a lot of like arbitrage stuff but I take over apartment buildings, right? And so there's nothing like a view, there's no beach access. But in these outdoor markets, the thing that's going to make you stand out is literally you get the overview look as opposed to the one half a block down the street that just has the regular street view, right? It could be the one that's on the sand for the beach as opposed to the one behind the street that's got the alleyway view, right? That's a big deal in those markets because you're the one standing out. On top of it, it's the way it looks inside, right? The design has a huge factor to do with how you're going to stand out in these markets. A lot of people don't see that. So I'm kind of happy you guys are bringing that up because it's a big factor in standing out, especially right now, man. Everybody and their mom wants to get into short-term rentals, and they don't realize that it's the hot new shiny object for literally every investor wanting to jump into. And now the competition's just gone extremely difficult to stand out and be the one that people want to book.
Yeah, I mean, a good test is just go on Airbnb and see what piques your interest. Like look at the different listings in a market and like what are the ones that draw your attention first and why. And really understanding who your avatar is or who the market or demographic you're trying to go after. Really, do the due diligence, figure out how you want to market, who you want to market to, and then browse the listings as if you were that person. And what do you think is going to capture their interest? That's a really good way to kind of position yourself and get set up for success.
Yeah, Adam, I think that you brought something up, and that's kind of what I've been looking at, and I've talked about this for years now. Is like those unique experiences. The people that want the house on the beach, like that's awesome. I want a house that's up the hill in the trees, like a tree house. I don't want to be that guy on the beach. Like I want to be that guy that has that property that I purchased. And, and I brought this up before, like back in the day when I first started off in 2015, you have, like 4 walls, a TV and a couple windows, and you're going to kill. Like you were doing extremely well. It was freaking amazing. Come fast forward 7 years now, like those people are either no longer in business anymore or their prices are cheap as hell. And they're only getting those, party goers or people that are in there they want to get those cheap nights in and out. But the way the future of this is heading is it's going to be dominated by professional operators that are going to be branded. And I think that the more that we look at this space as, you're getting into it now, your thought process should be, where am I going to be in the next 3 to 5 years? How much better is my customer service going to get? Am I going to have an on-site concierge? Where's the market heading? where am I at right now? And what's that trajectory looking like going forward in the future? And I think a lot of operators are just like, well, I want to jump in. I want to make this happen. And STR numbers look awesome. But dude, you got to think like so further ahead with what's happening. And, Airbnb is like, it's been around for a while. It's not brand new. It's been around for quite some time. Nothing's changed with Airbnb at all. The only thing, if you look at the last, if you look at the last 7 years, the only thing that's changed is they added experiences, which Daniel, you brought up.
Yeah, their algorithm changes is the only thing that literally changes.
So, and those experiences, those properties are pushed now to the very forefront of every single listing. It didn't matter if you kicked ass before and you were just a regular cookie cutter house. Now, if there's an experienced property, you're on the second or third page. So, what I see happening, and you guys just brought this up, is if you're going to be buying property, think about those unique type places that are different, that aren't just your standard, cookie cutter home, or you got to think outside the box and be that unique specific property and create the comp that's around that property. The market's going to decide what you're going to make. So, and I think that's going to be hard for you guys, like, as and maybe it's not hard, maybe this is something you guys actually look for, that if I bought a property in, let's just say Modesto, and I get this treehouse type property, there's nothing else around me, and I'm saying, hey, Daniel, Adam, I know that I'm going to be able to 2x what I'm making on my other property. It's only 200 a night. I'm going to be able to do 400 a night. And you guys don't see a comp on that. Like, are you going to have to trust my word, or like, how are you guys going to be able to like look at that? But I see that as like a really determining factor, that this person's going to be able to get 400. There's nothing else to comp it like. There's nothing else like it. The market's going to decide what those numbers actually look like. And 9 out of 10 times, those people get the money that they want per night.
Yeah. And I mean, that kind of goes back to what I was mentioning in the beginning, is like really being experts in solving whatever the problem may be, because the example you brought up is 100% right. There are oftentimes even properties that have historicals that were maybe mismanaged, right? They're not being operated at peak cash flow, and a new investor wants to come in and take it over, and they're projecting it's going to do double X whatever the historicals are. That's all great, and that's what investors, that's what entrepreneurs do, is right. They focus on that upside. Lending's a little bit different, right? We got to fit within certain guidelines that the capital markets have accepted for these type of loans. But there are strategies to take advantage of that. Just to speak about one is going in with like bridge loan options. Bridge loans are a type of financing that doesn't have that same DSCR requirement. They're typically 1 to 2 years in length, right? So you can go in with a bridge loan, acquire the property without having to focus on that debt service coverage ratio component, because the actuals aren't good, or the AirDNA data isn't good because there's not enough comps, but and your business plan is supporting a higher income. You acquire it with the bridge loan, you operate it for 1 to 2 years, you build up that track record history, that P&L information, and then you go and refinance and put the 30-year loan on it, because you've built that track record, and underwriter will accept that because it's been proven out. So, that's kind of what we've, try to, help our clients with, is, what's the objective, what's the goal, what's the problem, and then how do we solve that, right? How do we get the type of debt that we need to achieve that goal? So, it's a good point that you brought up.
I got a question for you guys. What about like if we have a property and it's showing like a certain projection and it's just been crushing, and then we buy one like next door, like in that same neighborhood, but your data shows something different than what my one property is doing. Can you guys take the data from my one property to use for the next property if I'm going to make it like similar to it?
No, I mean, we can't take information on one property and then just apply it to another one. It still has got to be, at least the way underwriting standards are written, it's got to be, AirDNA, or it's got to be historicals on that subject property, or income report reflected on the appraisal. So unfortunately we can't take that, but we can, use that information as part of like the analysis, the subjective analysis that's being done. But from like an underwriting point of view, we can't take, information on one property and apply it to another. But if that information is solid, you would hope that these various different aggregators, AirDNA, Key Data, any of these other platforms is picking up on that information and incorporating it into that type of projection.
Got it. I got a question for you guys. So and I talk about this all the time, and nobody talks about it enough, regulatory risk. Like San Diego right now, completely shifting the market where it was at, 2 years ago, to where it's going to be. I mean, there's regulations that are happening all over the place. So is that something that you guys take into account? Like if I wanted to pick up a place in San Diego, are you guys going to be like, nah, not going to happen because we don't know what's going to happen there?
Yes and no. Again, like regulatory risks is such a hard thing to kind of predict because, your point 2 years ago in San Diego, we were doing a deal, it wouldn't be an issue, right? It's hard to hedge against that, what may happen in the future, right? But it does come up because I think it was San Bernardino County recently put in like a short-term rental moratorium. I think it's passed, but at the time we couldn't do any more purchase loans out in the Joshua Tree market for a period of time because the county had that moratorium. So when things like that happen, yeah, it can impact the ability to get the financing. But as far as like hedging against future regulatory risk, it's not something that like someone on the loan side can really effectively do. It's really kind of leveraging, experienced operators, and it's really their kind of responsibility and part of the due diligence to understand what that regulatory risk might be.
Got it. So that leads me into the next question. Since I'm I would say I'm half short term, half midterm. So do you guys base anything off of midterm rentals? Like, are you guys looking at numbers like that at all, or is that something that you guys aren't really paying attention to?
Yeah, well, the tool that's used and accepted by the capital markets is AirDNA. So that is, aggregating information that is likely a mix of short-term rental and midterm rental data. So there's really no way to decipher that data in terms of midterm rentals. I did hear, I believe, maybe Mashvisor is starting to look at midterm rental data. I think they've partnered with a furnish finder to collect that data. But once again, what's accepted by the capital markets is the AirDNA data. And that might evolve as the asset classes evolve, but it's currently not. It's not here, and it's not that, there's no specific tool or piece of data that we can pull from to use that for underwriting.
But it's a great strategy for any investor to look at that traveling nurse market. It's a great, getting back to having a plan A, B, and C. It's a definite one to put in as a possibility to utilize in the events that markets shift. But I do think that as the asset class continues to grow, you will start to see, even on the short-term rental side, some of these different data providers start to become accepted underwriting standards like Key Data or STR Insights or any of these other ones. And then probably like Dan's pointing out, if Mashvisor or some of the existing legacy ones on the long-term rental side start actually putting out good data on midterm rentals, I think eventually those will get incorporated into underwriting standards too. Because capital markets are just notoriously slow to innovate and evolve.
Yeah, they haven't innovated, evolved at all. Like, really, I mean, there's like a couple banks that do stuff. And that's why I was so intrigued by you guys, is because, back in 2018, 2019, whenever I started kind of hearing about you guys, and I actually talked to Richard Furtig, which we talked about before, and he mentioned you guys in the past. And there wasn't institutions that were bringing on STRs, and they weren't looking at them in that way at all. So I think it's super innovative, and you guys are like forward thinking. I do think that it's going to be a slow evolving time where banks are going to, especially now with the way things are going, like, I don't know if banks are going to adapt this. I was hoping that they would, but I still don't see it. And I think that you guys are really leading that kind of space. And really, are you guys assuming those loans are yourself, or are you guys selling those off to other folks when they're
Yeah, no, I mean, the entire mortgage market in general, even your personal home loans, it's all built around the securitization model, right?
Right.
It all gets packaged into some type of bond instrument and sold eventually. Very rare scenarios where it's like community banks or, some local banks like that will actually hold the debt themselves, but even large institutions primarily securitize. But yeah, you got to remember too, short-term rentals really as like its own, there's always been vacation rentals, but this whole like building businesses and brands and stuff around it, obviously it's all kind of tied back to, when Airbnb launched, and they're the ones that kind of really kicked this thing off. That was back in 2008. I mean, we're talking, not that long. So, as a new asset class and as a new kind of rental strategy, still very, very early. And eventually there will be, more institutional, not only investors, as you're already starting to see some of the, the early, private equity groups and stuff like that are moving into STRs. But even on the debt side, you're going to start to see, those more traditional banks, start coming out with programs for SDRs too. It's just going to be a longer evolution. I think you can now, even like with like consumer mortgages, like you can count the income from Airbnb towards your debt to income ratio if you're buying another property or something. But it's only 50% of that income, and it's had to have been on your tax returns for like 12 months. So, there's still limitations to that. But that's just evidence that it'll become more accepted and it'll become mainstream. It's just going to go through the standard evolution process of a new asset class, I think.
Yeah, I totally agree. And we just had, before you guys hopped on, we were on another call, and I talked about how, these flippers, people that are flipping, are now like seeing the market shift, and they're holding on to properties. And now they're reaching out to me or Rafa and saying, hey, we want you guys to manage these short-term rentals or midterm rentals because the market's shifting and changing. So I think there's a whole new set of, you just talked about it being early. I've been saying this for a while, like Airbnb really is new. Like it really, if you think about it, in the grand scheme of things of time, like it's new. Like we're in the second quarter, probably, if you're thinking about football terms, right? We're barely going to be going into halftime at some point. But you also got to think about these other people that haven't got into the market yet that are now starting to see it as like, oh, wow, here's another opportunity. Here's a property management agency that I can pass this off to. Or here's an old school investor, which I'm seeing a lot of, these guys that have 30, 40, 50 doors that are like, I'm going to take my A style properties and now convert those into the short term. And I'm going to need to have somebody to bridge that gap, and I don't want anything to do with it. So you're starting to see a lot of that stuff too, especially with the market shifting and changing. And I still think there's a lot of upside and a lot of opportunity in this space. And again, I think it's cool that you guys are, looking at that and being, forward thinking in the sense that we can look at AirDNA numbers, underwrite these deals, and make them happen. And obviously, it's not a good deal. You're going to tell that investor like, hey, dude, this is not a good deal. Like, you should probably think about somewhere else.
Yeah, I've had that conversation before where we're running the numbers. I'm like, are these numbers correct? Like, is this the purchase price you're really going in? I checked on AirDNA, these numbers were just barely qualifying. And, when it's an investor that's in the market, they're like, yeah, I was seeing that too. Just want to see what the terms are. I think this one's going to be a pass for me, but I'm going to go try and find something else. So, when we're looking at our side, we'll give that opinion too. It's like, yeah, I don't know. This one's looking pretty skinny. Unless there's a different strategy here, you may want to, take a harder look or negotiate a purchase price discount or something.
Yeah. So talking about that right now, so you guys see a lot of numbers coming in. So like, can you guys give us like 5 places right now that you were like, I would invest money here? Is that something you guys are willing to share information about?
Yeah. I mean, it's, I'm trying to think of where we've seen really strong. No, it's kind of like the usual suspects, right? Like these locations that have some kind of experiential draw, right? Like in the mountains or in the beaches or something that's unique about them. We've seen like the northern Georgia area, like Blue Ridge and stuff like that, become a hotter market as like an alternative to the Gatlinburg market, which is has gotten pretty saturated. Some of these smaller beach communities, like in the upper panhandle of Florida, have looked pretty strong recently. I don't know, Dan, you've seen some pretty good deals out in Texas, I think.
Texas, but once again, I'm seeing numbers that are from a good operator. And when I analyze the market more, it's kind of like a C market. And I've seen, properties specifically on our DNA wildly underperform. So it really depends if you know your market and if you know the strategy that fits that market. You can make something work anywhere. It just depends on how well you can compete. And I will say, I looked at a tool recently. It's not out yet. I just remember looking at the output of this tool in terms of the data that they're collecting from a revenue from STR to ROI perspective with all the cash in, price of homes. And it's a lot of markets I've never even heard of. So I would say, don't go where the puck is, go where it's going to be. Start looking at alternative markets to like the Galveston markets or the Joshua Tree markets, and figure out where the trend for travel is going right now.
Yeah, it's a good point. With that, it ties into like the Airbnb experiences where you can now sort your search, not based on a destination, but based on an experience. So, you can find places that are going to have great returns by focusing less on where it is and the experience that you're providing.
I've noticed that a lot of places that are popping up now are like very small, tailored to like a little lake in the area, or like Jesse was saying, a tree house, or like, I looked at an area the other day that I never even heard of. It was somewhere in the middle of Wisconsin. And I was like, why are people traveling there? But it was like the coolest thing ever, right? It had like 3 acres of land, a forest. They built their own trail in there. It was like a cement house built with like a small tree house in the back. It had its own like obstacle course back there, and it was going for like $900 a night. And I was like, people are actually traveling to this place, and I found it just by searching for a good experience on Airbnb, and it was booked out, man. It was booked out all the way till the calendar was blocked off till like I think mid-November. And I'm like, wow, okay, right. And I think it does. It goes down to where people are actually traveling specific locations. Like for example, right in Michigan, all the people that live in Michigan travel to one specific location. People in California, they all travel to one specific location, right? And so you got to look at like those type of locations and kind of pick and choose your market of where you're going to go, and make smart decisions by being able to run those numbers yourself, right? Like we can all go and pick a spot on the map and say, hey, I think this place is going to crush just because I like it. Well, then you run numbers and it's just a terrible market, right? Like you were saying, down it's like a C market, and you're like, well, why is this a good market? Well, because you might have 1 to 5 good operators who know how to crush that market. Mm-hmm. But then you come in and you don't know what you're doing, or you might just be that one off person that's not going to bring any attraction to that place. You're not going to do very good at all, right? So it's very, very important to be able to make sure that when you're running these numbers, that they're making sense and that you know what it is that you're offering. A 3-2 cookie cutter house is no longer going to cut it, right? You got to have some sort of experience in some type of location, in some kind of amenity that you got to offer for people to book. Because like you said earlier, Daniel, people are booking Airbnb for large parties to go to specific locations. Like if I'm going into a mid city now, I will book a hotel if it's just me by myself. There's no reason for me to book an Airbnb, whether it's a studio or a 1-bedroom, because the fees are going to crush me. Plus the cleaning fee is going to crush me. Like I'm going to end up paying way over what I would pay at a normal hotel. But if I'm going with a group of like 6 or 7 people, absolutely, I'm going to book an Airbnb, because now you split the cost between 7, 8 people, right? The fee's minimal. And now you can all stay together in this big place. And now you can pick and choose if it's based on just the size of the place or the location of the place or what the place has to offer. And that's something that people really got to keep in mind when they're trying to build their short-term rental business. What's your demographic of customer, and what's the place that you're going after?
Yeah, I totally agree with you too. And not only that, but like experiences, I think we're talking about like going into a tree house and all these like crazy, you're staying in a house that looks like a boot. Yeah, like those are cool. But you can also like buy like this is me just thinking off the top of my head, buying like a mid-century house and, making it look like Don Draper's house from Mad Men. You can like literally call it the Don Draper house, and you create an experience from. That's actually a good idea. I think I might do that now.
Yeah.
I'm not
giving away all your good secrets.
Shit, man. What am I doing? So like, as I'm talking about this, I'm like seeing it in my head. Like literally, you can take Don Draper's house from Mad Men and like create that into an experience. So you buy a mid-century house, and that's what you do. Like you create the experience just in the property itself. You got that aesthetic to it, and then you make it something. And I think that's where it's the canvas, right? It's like a piece of art. And I think that a lot of times like brand new operators don't think about it like that. They don't have that like mindset yet. They're just trying to like emulate what they've seen other people do or how much money they're making, or, they obviously, a lot of these people want to get out of their W-2 jobs, me being one of them. Like, I don't want to work at my W-2 forever. So this is another way for me to, create income, but you got to think about it more of like creating something. And I think we're going to edit this out so that I get my Don Draper house and nobody else copies mine.
Yeah, you want to create the experience. And also I want to highlight, you don't want to just rely on Airbnb. I know when we mentioned short-term rentals, it's synonymous with Airbnb. So think about how you can take those customers off of Airbnb. Have a direct booking site, find innovative ways, whether it's through Wi-Fi logins to like submit an email address to remarket to the customers. With the midterm rental strategy, especially, I think it lends itself more to creating actual relationships and doing direct marketing with like hospitals, corporate housing, networking events, for corporations, and really thinking of it as the house is my business. It's not Airbnb. That's my business. That's just a platform. And as you can see, as algorithms change, a lot of operators that were on the first, set of results are now, their business took a hit because they're only listed on Vrbo and Airbnb. And, this is your business, and you have to think of it as if you're doing your own marketing, your own remarketing, and just definitely want to highlight that if you're, a new investor or a new operator, it's in a short-term rental business or midterm rental business, not an Airbnb business.
I've been saying that from day one, man. Daniel, you're preaching out here. Yep, 100%, dude.
Yeah.
People gotta focus on getting away from the OTAs so that you can generate your own revenue and build your own brand 100%.
Or just not rely 100% on it. I mean, because, even people that develop very strong direct booking strategies and stuff like that, they don't necessarily completely turn off
No.
Airbnb. It's a marketing channel. It's one avenue. But you want to have more than just one. In any business, you don't want to have just like one specific revenue stream where a disruption in your supply line and now you're done, right? You want to have that, diversified income, deal flow, whatever you want to refer to it as.
And you also got to know what platforms work well in what locations, right? Like some places are very VRBO heavy as opposed to Airbnb heavy, right? So that's something that people have to keep in mind. Anyway, guys, we're getting to the top of the hour, and I want to transition here to our segment where we always ask the two questions to all our guests. And being that this is the Big Break Show, I want to ask you both. We'll start with you, Adam, and then Daniel will go to you. We're like, what was your big break that got you from old Adam to new Adam, old Daniel to new Daniel, whether it was life, business, relationships, whatever the case may be?
Well, I mean, I think if we're talking business, it was really trusting in myself and trusting in Dan and trusting in just kind of going off on our own to start this company and believing that we could actually do it. Like I said, I was in a very, traditional, high-paying real estate development job. When I left that to start this, to build a startup and be entrepreneurial, I've always wanted to make that leap, but just never had actually done that. So I think, trusting that we would succeed, that was probably my big break.
My big break was, I don't think I was born an entrepreneur. I grew up with 9-to-5 parents, but in college, I really focused on my mindset and the thought that I could really make anything happen. And again, the trust in myself to do that. So I read some books like, Think and Grow Rich, Rich Dad, Poor Dad, some more spiritual content like Eckhart Tolle, The Power of Now. And all that kind of shaped my viewpoint of the world and really transformed me into thinking anything is truly possible. And, if I have this internal locus of control that I can shape my reality and provide value to people around me, I think that put me on a totally different trajectory from if I didn't come across as these pieces of information or even the mentors that I had at the time. So really, I'd say that was my big break, was really being open to and that information.
Yeah, super smart.
Yeah, I think that's huge because getting to that point too, it focuses, it shifts your mindset to be able to not only try new things, but do new things, and gives you the confidence to go out and actually put one step forward to get to that another point. So I appreciate you sharing that, man.
Yeah, it's definitely good insight. So you guys, part of the segment too is an actionable step that somebody could take literally after listening to this episode. So what's something that you can give advice? We'll start with you, Dan. What advice can you give somebody listening to this episode right now that they can literally learn and apply, make something happen?
Oh, learn and apply? Well, definitely inquire with Jesse and his programs. I'm actually personally interested in, your midterm rental program. So I would say do that if you're looking to get started.
Hey, man, we're supposed to be plugging you, not plugging me right now.
Go to hostfinancial.com and use the AirDNA Rentalizer tool. It's accessible for free. You can start analyzing markets immediately, plugging addresses without having to log into AirDNA itself.
Oh, that's a good one. Adam, what about you?
Obviously, hostfinancial.com. We'd love to, even if you're getting in contact with us or one of our account executives, we're happy to, offer any type of advice. Certainly for anybody starting out, in addition just to the financing thing, we talk about, how to structure entities, for the most advantage, at least from a loan perspective. So we can give all kinds of advice on that. But aside from the business thing, I would say, just kind of tying into what I said before and what Dan was saying is be open to, changing your mindset and then ultimately just believing in yourself, because you'd be surprised. When you finally, every single person, any person that's ever been successful, they always have the same, it's I was really nervous. I decided to take the leap and I just went for it. And I'm so happy that I did it because, you know, I've built this out of nothing. And if I had just sat on the sidelines and been afraid and doubted myself, there's always doubt. There's always people, you know, even myself, you know, you get to sometimes where you're just, you know, unsure about directions that you're taking and things like that. But it's just, you know, if you trust in yourself and you put in the work, you know, 9.9 times out of 10, you know, you're going to get the results that you're looking for. So that's what I'd say.
I was excited about what you just said, Adam, because 9 out of 10 times people don't believe in themselves. They'll believe in their ideas. They'll believe in all these things, but they don't actually like sit there and believe that they can actually achieve these things. They believe in the idea and the vision, but not in themselves. And I think that's such a huge shift in mindset. And Daniel, I see your posts all the time online. I don't know if you're reading Ryan Holiday's stuff or what, but you have a lot of stoicism.
Daily Stoic every day.
Daily Stoic. Okay, cool. Yeah, if you guys haven't heard of Ryan Holiday, check out a book called The Obstacle in the Way. That was a really, really good book. Takes a lot of ancient like proverbs, right? Kind of ancient kind of philosophies and thought processes and puts them like into actual verbiage for today. So it's really kind of cool to listen to. But
yeah, he has some great books. So the Daily Stoic, pick that up. It's my most gifted book. And
it is now my most gifted book too, thanks to Dan. Yeah,
something I post every day in our Slack channels for the team.
Yep,
it's great content, and I think it's good for any entrepreneur.
We have a copy in every one of our offices.
Yep.
And then I think there was a saying that, you know, instead of, especially people that are thinking about doing this and seeing other people, instead of thinking like, why them or why are they the ones that are being successful, change that mindset to like, why not me? Like, why, you know, it's, I can do that. It's not like, why, I can't do it. It's like, why not me instead of why them? And that shift and belief in yourself will take you to the moon.
100% agree. Yeah. You guys, this has been fantastic. So where can folks find you? Give us the nitty gritty on where we can find you on the Instagram, on the websites. I mean, whatever you guys have going on, let's plug away right now.
Yeah, it's all, it's www.hostfinancial. It's HOST financial.com. Instagram, Twitter, all those are the same handle, Host Financial, as well as Facebook. Yeah, love to connect with anybody.
Awesome. Well, there it is, folks. We got Adam and Daniel, the two. Oh, you guys are both co-founders. Is that what you guys are calling yourselves? Is there a CEO? Is there a COO? I mean, who's what here, guys?
Yeah, co-founders. Yeah.
Co-founders. Awesome. You guys, for your short-term rental needs or mid-term rental needs, reach out to these guys. They know what they're doing. They are literally reinventing the wheel when it comes to financial institutions actually looking at short-term rentals and revenue and what you can actually do as far as getting an actual loan. So please reach out to them. These guys know what they're doing. They're not new at this. They've been in it for a long time. And this is the way that the market's heading. So you've heard it here first from people that are actually making things happen. They're progressive thinkers. And yeah, they're probably going to, one of you guys, Daniel or Adam, is going to take my Mad Men idea. I'm going to be pissed if I find out it's one of you guys.
But we can partner on it.
Let's do it, dude. I promise. Let's find a place in the middle in Wisconsin somewhere near a lake. And because there's a bunch of like mid-century cool houses that are like $200,000 that people just like leave, or they're like hand-me-down family. I see them all the time. I always like think about
Let's
that.
Like, I'm drawing up the operating agreement right after this.
Yeah, I think you've got a gold mine right there.
I know, right? That's awesome, guys. Well, we appreciate you guys for being here. We'll leave all the show notes and stuff down below. For those of you that this episode resonated with, please like and share this with people that you love and care about. We obviously want to get to more people, and we obviously want Host Financial to have business where people can head over and get some deals happening. Reach out to Daniel, reach out to Adam, and we appreciate you guys for being here, man.
Yeah, thank you, Jesse.
Great time.
Gentlemen, thank you so much. This was awesome. Thanks for coming on.
Thanks, guys.